Hi there, Adam Goodman, independent financial advisor, Las Vegas, Nevada. I hope this video finds you well. It is mid-June. We are coming off one of the worst stock market weeks in decades. We're coming off some terrible start to the year, first quarter, second quarter. Wanted to make a video and share with you some thoughts, give you some perspective. If you pay attention to the news flow, understandably, you could be very concerned. We want to make sure we're managing our emotions, not overreacting. And so there's definitely some tried and true, in my opinion, things for us to keep in mind. You know, one very simple concept that's often attributed to Warren Buffett, the idea of being greedy when others are fearful and being fearful when others are greedy. I know it's easier said than done. I'm always surprised by the extreme movements in the general stock market. It kind of surprises me in both directions. How it can go up a lot more than what one thinks it maybe should. And often it goes down much more than one thinks it might, or whether you want to say it should as well. It's really obviously predicting short-term movement in the stock market. No, we want to position for the long term. We want to focus on things that we can control. This week, the Fed raised interest rates. They've been telling us they're going to do that. The last two times the Fed spoke, the market responded favorably on that Wednesday when the Fed announced what they were going to do and their findings and had their news conference. And then the following day was one of the worst declines. And this week that's the second time this happened. So it's important to understand that the Fed has scheduled meetings upcoming. The next one is toward the end of July. There's another one in September. They're already telling us that they're on a path to continue to rise interest rates. So if you're watching the news, you're going to hear about rising interest rates and inflation and recession. You know, are we in a recession? Are we going to be in a recession? And so it's important, again, to understand that generally the market is forward-looking. That's why I think, you know, I had a client ask me a question this week. If all the interest rates are so high, why aren't we seeing higher bank CDs? So there's a difference. So that the Fed funds rate, which is starting to go up, so I wouldn't be surprised if we start seeing higher CD rates. But the 10-year Treasury has, which is what a lot of insurance products, fixed annuities, fixed index annuities, are based on their pricing, is based on the 10-year Treasury. If you look at the 10-year Treasury, it's over 3%, and it started under 2% for this year. So it's had a very large move in a very short period of time. The recession is two quarters in a row of declining economic activity. So whether we're in a recession, you know, we're going to be in a recession, you're going to hear a lot of news about that. And a lot of people are going to talk very negatively about that. So I've no idea if one will occur, but I would expect one will occur sometime later this year or in 2023, because we were coming out, if you compare the recent quarters to the previous year's quarters, 2021, we were coming out of comparing that to 2020, right? We were coming out of a period where people were shuttered. They weren't able to go out and do business and travel and do all the economic activity that is more normal, right? So when they were, you would expect a little bit more of a spike. And so if you're comparing 2022, 2000 and so forth to those previous years, it would be natural to expect that they'd be lower, right? So don't be surprised. Have a plan. How are you going to react when these negative type of events occur, right? It's very difficult. You know, sometimes people say, well, I want to sell my investments now and I'll get back in when it's better, right? Be very clear. If you're going to try that approach, be very clear what your strategy is. You have to be right twice. You have to get out and then you have to get back in, right? It's not to say that you couldn't or shouldn't maybe make some adjustments. And I think that's very important to look at your portfolio. And because asset classes have moved quite a bit, your asset allocation could be quite off where it's supposed to be. And so there may be opportunity to go in there and make some adjustments, buy some things. So the general stock market, major indexes are typically, or right now, it depends what you're looking at, but the S&P about 20% down, a little bit more, NASDAQ closer to negative 30%, but they call it underneath the index level. So many individual stocks, especially growth tech stocks, are down well more than those index levels. So depending on your timeline, depending on your risk tolerance, it may make sense to, ultimately, unless you're going to be short the market, you buy low, sell high, right? So if there's things that you like and you're still confident and comfortable in, it might make sense to buy more in the current environment. You always have to look at your timeline, your risk capacity, your risk tolerance, have a plan for if it doesn't work out, right? If you buy it and it goes down, what are you going to do at that point, right? So I'm not giving individual advice here. Each person's situation is different. There's no guarantees with investments or investment strategies that one strategy is going to work out better than another strategy. I emphasize having a solid financial plan, looking at 5 different areas: your estate planning, your investment planning, your insurance planning, your income planning, and your tax planning. And when we do that, we build a plan that's designed to sustain negative environments like this. We hope for the best, but we protect against the worst. So if you don't have a plan like that, if you're not working with a professional that integrates those different areas, the majority of the investment world just focuses on managing investments. And if that's all you want, that's fine. But just realize that there may be other things that are relevant and are important to you that you could control, that may be being overlooked, that you may not be making as optimal decisions that you could be. And so I think it's a great time to just reassess. If you have a change in your life, a lot of people have reassessed their work situations. So quite a bit of people have the majority of their assets in their employer plan. So once they become 59 and a half, or if they change their job, you typically now have access to those dollars, and you can transition them into an IRA. Is typically what is done. There's no taxation involved if it's done properly. You generally want to work with a professional, make sure that transaction is handled properly. If it's not handled properly, there could be some tax implications. The reason why a lot of people do that is because outside of the employer plan in the IRA, you have a lot of more options over how those dollars can be invested. And we work with clients in multiple different financial strategies with different degrees of upside and downside profiles and buffers and downside protections and so forth. So can't get into any specific details on this. If you have some questions on that, you'd like to have a conversation, feel free to reach out. I hope this has been helpful. I just want to get something out there for our email contacts. Some of you I've had conversations with, some of you I don't know at all. You don't know me from Adam, type of thing. But I like sharing ideas if it could be helpful for people to help them create their best outcomes. That's what we're here for. That's what we do. And I hope that these ideas help you navigate whatever the next few months remaining of this year happens, which I don't see any reason that for anyone to expect that it's not going to be a little bit of a roller coaster ride. So have a plan for that and reach out if it makes sense to do so. Otherwise, take care. I'll talk to you in a future video.